There's
And
no other instrument in the financial world, in my opinion, that equals an option. Whether it's a futures option, a forex option, or we've been talking about equities options, obviously. So here's the next thing, and I want you to elaborate on this. An option has a lifetime. If you buy IBM, the chances are you could have bought it obviously 100 years ago had you been alive, and IBM hopes they're going to be around in 100 years, although Eastman Kodak hoped the same thing, and Lucent and a bunch of others, right? Point being that an option has a limited lifetime, and during its lifetime, it has 5 key components, and there are more, but these are the 5 key: delta, gamma, vega, theta, and rho. Why don't you define those for us? Because that shapes the nature of the option over time and gives it its uniqueness.
so delta is its sensitivity to the move in an underlying, whether it's stock or future or whatever the option is. So let's use a stock. If the at the money option, meaning the stock's trading $45, I want to own the stock at if it's over $45, I will buy an option to own that at 45, on the 45 strike. All these terms are
They're going to be super. We're going to do it for them, Paul.
okay. And so you can buy that option, but you may get better leverage because you're in your head, you say the stock's going to 60. And so you can buy a lot more 50 strike options, meaning by the end of September, is it going to go up above 50? You could buy an option that you have the right to buy that stock at 50. They're going to be cheaper than the ones at 45 because those are way more sensitive to the stock price. And you have that $5 head start.
Yeah, we should explain to them that out of the money options.
Gamma is how much that sensitivity changes over a period of time. So, and I think, it's been a long time since I've done options theories. So I think it's over the next one increment, meaning dollar. I think it's a dollar move, but I think it actually changed. It's a continuous curve, but it's to judge the change of the delta over time. So 40, if the stock's at 45 and you're talking about 45 strike, it's going to have generally roughly a 50 delta. If you're, and the 50 strike is going to have, depending on the other components that we'll be talking about, will have something lower than a 50 delta. It's going to move less than 50%. Vega is the volatility component. It's how much you expect that stock to be bouncing around, really. And if you're expecting quite a bit of bouncing around, that at the money option is going to have a lot of value because it's going to stop you from having to put out $45 to buy the stock. You could put out $1 or, for the next month to actually get the performance of it, or, but if it's a super volatile time, it could be cost the same option, same amount of time till expiration, could be trading for $5. And it's uncanny how well priced all of these things are over time.
Market efficiencies, right?
Oh, yeah. Yes, that's amazing. I still marvel at it every day when I see that.
It's astounding. And as I mentioned earlier, an option has a life. You don't just buy an option and it's infinite, it expires, kind of like we do. And some options, when Paul was first trading, there were only monthly options. So they only expired 12 times a year. All right. And then leaps came into the market, and then weeklies came into the market, and now dailies, what we call T+0 options, came in. When you make a trade, when it takes to clear it. But how do you keep track of all this, the theta of that? Because if you're long, I remember one time when you came home from work, we were on the train, and you said, "Yeah, I got this position on, and I'm just tired of it." I said, "Why are you tired of it?" Because I'm always long the option. It's like, well, that seems good. You own it. But I didn't know anything at that time. But that's because sellers are pushing this stuff on you. So that's got to be, and are most of the guys in the pit because they're on the other side of people's doing buy rights, right? Super that too, Josh, buy right, right?
Yeah. At the time, yes, it was more predictable. You would get, that was the play of the public customer. So, but now it's pretty balanced. I mean, and it's so, they're so tight and so efficient in most spots. You can look up things that are the, 2000th most traded option series, and it's going to have wider markets. But if you get into the SPYs and those types of options, they're penny wide.
Oh, sure. Tesla for sure. Yeah.
You get in there, and the great part is you can get in and out, and you're getting a very fair price. The bad part is it's a really fair price. So you
it's
have to have
tough for what you're doing. Yeah, it's tough.
Yeah.
So here's what makes it even more complicated. I'm just trying to get you guys to understand what this man has done. We talk about expirations, right? Well, there's American options, and those can be called anytime. So if you write an option, they can call it away from you and say, nope, we want the stock, or we're going to put the stock to you. That's where the word put comes from. And then there are European style, which you can only exercise on the day of expiration. And it's not necessarily just in America or just in Europe, so don't worry about that. It's just the style. All right. So when the indices, I don't even know, was the OEX in the 80s? Was that European? Because certainly the SPX is now an XSP, the minis.
No, it was not European. And that's actually what probably sunk it, and became a lot less attractive to retail investors and smaller investors, because you would have funky moves after the close, and you could exercise those options when the market was going to have a huge move the next morning.
Yeah. And for you on your particular side of the market, that's got to be frustrating. You sell a butterfly, super that, Josh, and you decide, well, I'm out of the money by 8 cents, but in case something happens overnight, my lower leg protecting me is going to expire worthless. And now all of a sudden I'm short instead of neutral. Oh, and by the way, it's a 300 lot. It's really risky. So the last component, you guys are, again, you're watching this later, but Paul and I are wondering maybe what's going to happen with the Federal Reserve tomorrow. They're going to cut interest rates. So interest rates and options don't really matter if you're trading dailies, as we've talked about, or even weeklies. But if there are companies that need to, or entities that need to hedge with options a year away or 9 months away, RHO comes into play. Talk about calculating that in what you're doing, Paul. If it was a factor, it's probably the least known of the five. Yeah,
it was the least